Hello and welcome back. Today we'll look at one of the key bases of accounting, of understanding the financial statements. We're going to be looking at the differences between the cash basis accounting and the accrual basis accounting. How does this play out in real life? So the cash basis accounting says we only record or we only recognize income the moment actual payment is being collected, the moment actual cash is being received. That's for revenue. And in case of expense, the moment actual cash is being dispensed to those whoever we're owing. That's what cash basis accounting is saying. While accrual basis accounting is saying we should recognize revenue the moment it is earned, not when actual cash is being received. So we're going to be taking examples later on, but understand the concept. Accrual basis says we recognize income the moment it is earned and not when actual cash is being received. Same thing applies to expenses. The moment the expense has been incurred and not when we actually pay or we actually dispense cash for it. So cash basis is saying the moment it is being the moment actual cash is being received, then you recognize this as a revenue. And the moment actual cash is being dispensed, you recognize it as an expense. Or your accrual basis is saying, no. The moment cash is earned, that's when you recognize it, regardless of whether cash is being collected or not at the moment. You can collect cash in the future, which leads to owings, accruals, and prepayments and stuff like that. Yeah, but for expenses also, it says when the actual cash is being incurred and know where actual cash is being dispensed. So the application of accrual basis leads to what we call prepayment and what we call accruals. So prepayment basically says this is an advance payment of goods and services. Advance payment of goods and services. Before the services is being rendered, the customer pays for it down. So that leads to prepayment. While for accruals, the service has been rendered while the customer is owning the business. Same thing applies for it can happen in case of the customer, it can happen in case of the business also. So we have prepaid income, we have prepaid expenses, we have accrued income, we have accrued expenses. So that's the main differences between the cash basis accounting and the accrual basis accounting. So let's take some case here. Yeah, so we have the case one and case two. So we'll look at the difference between cash and accrual basis. So the first case says a company disposed of its motor vehicle for 20 million naira. Payments were on credit and were to be paid in the following financial year. Now we'll take it in the first instance of the cash accounting, cash basis accounting. Now, even though payments is to be made in the following year, you see a payments to be made in the following year because we dispose this thing of on credits, meaning the individual or the company that we sold off the motor vehicle for, off to rather, is owing us. They are owing us. The payment is not be made instantaneously. So the year in which we are going to receive this actual 20 million, that's the year we are going to actually record the revenue, which is the following year. Let's assume this is 2026, then the next year, which is 2027. That is when we are going to actually record 20 million naira as our revenue. But in the case of accrual basis accounting, we are going to record the revenue that same year, which is 2026, because income has been earned now, even though it has not, even though cash has not been received, but we've earned that income. So we're going to record 20 million in 2026, while for cash basis accounting, we're going to record the 20 million when actual cash is being received, which is 2027. That's for case one. For case two says plant and equipment of $1 million were bought to be of use for the next 10 years. Now, this is what we call okay, like before that, on a cash basis accounting, we just record the $1 million because the cash has been dispensed. We bought the plant and equipment. We have no information if it is on credit, so we assume that it is on cash. Cash was paid instantaneously. So for cash-based accounting, year 2026, we remove it $1 million as an expense out. That's it. What for accrual-based accounting it's going to lead to what we call depreciation. Depreciation. So depreciation is basically a gradual reduction in the value of an asset. Yeah. So what we're going to do is we take the total amount of the assets, we divide it by the number of years, which is 10 years. So $1 million divided by 10, we have 100,000. So this 100,000 is always going to be in our books over the next 10 years. So we have year one, 100,000, Yeah, 200,000. By the end of 10 years, we have the accumulation of everything amounting to this exact 1 million. So that's the difference. We will look at the difference between the cash and the accrual based accounting. Again, for case two, it may seem a little bit technical, not really technical. Look at what we call depreciation. Depreciation is very key. So basically, like I said, your 1 million divided by your 10 years, which is the number of use of assets, basically your number of use of assets. So 1 million divided by 10 years. So we have 100,000. Yeah, we have 100,000. Yeah, so Accra Business is telling you that no, don't just net off the 1 million together in 1 year. Let's do a gradual reduction, a gradual reduction in value. Yeah, reduction in value. So split it over the number of years that the asset is going to be in use. Well, cash based accounting saying no, no, no. Cash has cash has been dispensed in this year. So just net everything off, remove the total $1 million. That's it for the difference between cash based accounting and accrual based accounting. Just to sum it up, like we said cash based accounting, revenue is recorded only when cash is being received. When cash is received, all expenses when the actual cash are being dispensed. Well, for accrual based accounting is selling, you recognize income or you recognize revenue when it is earned and not when it is received in cash. Well, expenses should be recorded when they are incurred and not when actual cash is being paid out. Thank you very much for meeting Nezu.